I'm Pierre Daly. We're at the Inside ETFs Conference in Montreal. Joining us right now is Alfred Lee from BMO ETFs and BMO Global Asset Management. Alfred, thanks so much for joining us.
My pleasure, Pierre.
So how are you finding the conference so far?
Very good. Good energy about the conference. It looks like there's a lot of providers here, a lot of participants as well, and there's a lot of good information being shared. So it's a great conference so far.
Alfred, in some of your recent analysis, you've spent a great deal of time talking about how advisors can position their clients, how investors can position their portfolios for this market where we see rising rates. Is there anything in particular that you want to share with regards to strategy?
Yeah, so I think the big question now is fixed income. Given that we've been in 30-year secular kind of bull market in bonds, I think one of the big concerns right now is that because we have rising interest rates, the big question is should you still remain in a passive strategy? So I think in the last couple of years we've seen a lot of active ETFs gain a lot of traction, and the common story has been in a rising interest rate you don't want to be in a passive ETF, and we offer both passive and active ETFs.
Right.
So I would say our viewpoint's a little bit less biased, where in a rising interest rate environment, one thing to keep in mind is that, they look at the Canadian fixed income market as a 7.5 duration. So a lot of people assume that in a rising interest rate environment, that duration is going to hurt you. But last year was a good example where rates on the short end rose, but on the long end, they actually went down. So fixed income market actually did very well in the rising interest rate environment. So
yeah, I think if you're thinking about duration in a linear kind of way,
exactly, yeah,
you might think it's higher risk. It looks like a higher risk than it actually is.
Absolutely.
Right.
Yeah, and I think the common approach that we've been hearing is that in this environment you have to go active, but that's based on the decision that the active manager is going to make the right decision. So in the last couple of years, passive managers or the passive index has actually done very well. I think according to Morningstar data, it was 50th percentile in 2016. 2017 it was 31st percentile, meaning that it beat out 69% of its competition active in there as well.
But it's been kind of a wonky market, though. I mean, very all along the way for the last number of years, people have been calling for the end. It's the end. Yeah. It's the end. It's the end of the bull market.
Yeah.
But the end just kept on getting, interest yields kept on falling.
Absolutely. Yeah.
Right. And because there was this continued sort of risk off attitude in the bond market, while equities kept on going with the risk on attitude.
Absolutely.
So it was kind of quite a divergence between what the bond market was saying and what equities were saying.
Yeah, for sure.
Right. So now is it finally? I mean, some people have recently come forward and said, I think Byron Wien recently called it the end. Mm-hmm. And I mean, so is it finally the end? Is the bond market finally sort of capitulating? Is with rising rates? Or do you disagree with that?
I kind of disagree with that. I mean, the last 2 years has been a good example, as I mentioned. Rates have gone up. Fixed income has performed well. Keep in mind, there's that duration, as I mentioned before. But in a rising interest rate environment, as long as it's not inflationary, credit does well. I mean, right now rates are going up because the economic backdrop, especially in the U.S., is very strong. So that's positive for credit. And default rates have been relatively low right now. Even when we look at the high yield market, typically when bankruptcy or kind of defaults happen, it happens in the high yield market before the IG market. Mm-hmm. So we've been recommending things like pulling away from high yield. So in the last couple of years when interest rates were a lot lower, people were stretching for that yield, and I think that trade worked. But now, as we've kind of gotten a little bit long in the credit cycle, it makes sense to kind of dial down that risk and go into more investment grade rather than high yield, and not stretch for that yield. But you still have that credit exposure to offset a little bit of that duration exposure as well.
Yeah, I think on the active side, I think the active argument is as far as high yield is concerned, is go to the shorter duration.
Yeah,
it's a shorter maturity. 1 to 2 years out, the risk is measurable.
Yeah,
controllable. Do you agree with that statement as well? Or
so in theory, yes.
Yeah.
But the thing with the high yield market is that a lot of high yield is based on refinancing, right? So in this environment, when you could easily refinance that debt, and easily roll over.
Yeah.
Exactly. Yeah. So you can, if something is called, you could just reissue another bond, lengthen out that maturity again. in 2008, that was a good example where that liquidity dried up. So that ability to refinance that bond, essentially, it's not there anymore.
It became very difficult.
So it works until it doesn't. So right now it's working. The issue with staying in short-term high yield, and if you get caught in that kind of deleveraging or kind of default kind of crisis, it's going to be very tough to refinance, right? And those are the short end is going to be the period in question or the term in question. So I kind of agree with it in theory, but I think in actuality,
but it's not fail-safe.
Exactly. Yeah.
What are your thoughts on the fact that default rates are historically very low as an argument?
I think it is a valid point. I think we often say this time it's different, but I do think it is somewhat different. Reason being is because the depth of the recession in 2007, 2008. One thing is that if you look at the overall index, it cleaned out, for lack of a better term, it got rid of a lot of the weaker hands, right? So a lot of the companies that had higher debt levels, those were essentially washed out of the index and forced into bankruptcy.
Right.
So coming out of the recession, I think the overall universe, it was a lot more kind of robust, stronger companies in there. So I think in addition to that, I think the depth of the crisis back in 2007, 2008, was a lot deeper. So, this economic recovery should last a lot longer. So, when you look at historically how long economic cycles have lasted, we're definitely in the later stages right now.
Right.
So any way you slice it, whether there should be a longer cycle or not, I do believe that we're probably in the later cycle of both the credit cycle and the equity cycle as well.
So your thought there is to focus more on the investment grade side.
Yeah, investment grade, and I think if you want to look at kind of more safe haven assets, so things like U.S. Treasuries,
right?
Potentially put options in your portfolio as well, just to get some insurance. I think that's a good idea as well. It doesn't mean take 100% of your portfolio and go into the U.S. Treasuries, but if you want to slowly start building up that allocation, so you have some safe haven assets in your portfolio, it definitely makes sense at this stage of the game, I think.
Alfred, what are your thoughts on preferred shares right now?
We think it's a good investment. I think obviously we're in a rising interest rate environment still, so a lot of bond investors, what we've been finding is that they want to manage their duration risk. So the common theme has been going short duration, but as we saw last year, when you go short duration, in theory it works. I mean, you're reducing your duration, but again, it goes back to that only rings true if we get a parallel shift in the yield curve. However, when you look at the short end of the yield curve, that's actually the area that's the most sensitive to the Bank of Canada and what they do with rates. So to offset a little bit of that duration risk, I think having things like preferred shares, like rate resets or floating rate notes or whatever it may be, can offset a little bit of that duration risk, and that's a better way to manage that duration risk, I think.
Any thoughts on the risk of a recession in Canada? Given some of the recent moves and the Bank of Canada's stance on,
I think so.
And tariffs, trade volatility.
Tariffs is definitely one concern. I think the main concern that we have right now is more so household debt. So I think when interest rates were low, as the Bank of Canada and other central banks around the world were trying to reflate asset prices, I think a lot of people just took advantages of lower interest rates. So mortgages is a good example where house prices have gone up, not because income levels have gone up, but just because people were offered more mortgages.
Right.
And people just took on more mortgages, overextended themselves. When we look at household debt levels, record highs in Canada. So I think the Bank of Canada is really limited in terms of how much they could raise interest rates. So, my concern is that if the Bank of Canada moves too quickly, it kind of forces or puts a lot of pressure on these households, and potentially we move into recession. So the Bank of Canada is really handcuffed in terms of how quickly they can move rates.
Yeah, so they've got a little bit of dry powder, but not much more room.
Not like the U.S. I mean, in the U.S. there are...
you see the fundamentals being much stronger in the U.S.?
Yeah, absolutely. I think if you look at unemployment there, I think it's the lowest it's been in a long time. I think it's something since like 1969 or something I recently read.
But is it true? I mean, there's some question about whether or not it's truly a full employment situation, or if there's a lot of sort of short-term labor or part-time labor involved in that figure.
Yeah, so yes and no. I'd say participation rate is definitely lower.
Yeah.
That could be higher. But on the flip side, when we talk to a lot of strategists down in the U.S., what we're finding is that one common story we often hear is that skilled labor, they keep trading up in terms of their employment situation. So they'll leave a job to go for a better job. So I think if in terms
of going for re-education,
in terms of skilled labor, we're definitely seeing better employment situation there.
So America is actually moving back up the value chain?
I think so. I think so. And I think our main concern there is kind of more wage push inflation. So we potentially get inflation by the end of the year in the U.S. So our concern in terms of bond positioning in the U.S. is just kind of avoiding the long end of the curve where that tends to be more sensitive to inflation.
Alfred, thank you very much for joining us. It's great to see you and it's great to meet you.
Yeah, likewise.
Thank you.
Thanks for here.